Good day, everyone. I'm Nicola Probyn, one of the directors of the Africa Scotland Business Network. A very warm welcome to the third episode of Talking Up Africa, a live business show brought to you by the Africa Scotland Business Network. We host Talking Up Africa every couple of months, bringing you leaders and experts on Africa. And today's show is all about how to invest in Africa. For those of you joining an ASBN event for the first time, we're an international business network based in Africa, but bridged with Scotland and increasingly the rest of the world. We're a dynamic network with over 100 member companies from over 14 countries around the world, representing over 26 sectors. Our core purpose is to unlock opportunities for our member companies in Africa and the UK. If you'd like to find out more about us, please feel free to reach out to the team or visit africascotland.network. I'm delighted to welcome our moderator for today, Steven Gray OBE. Stephen heads up UK export finance in West Africa. Thank you so much for your time today, Stephen. I'm going to very quickly introduce the rest of our panel in order of their appearance. We have the wonderful Tara O'Connor, CEO of Africa Risk Consulting. Tara is an investment analyst with over 30 years experience in African corporate and political risk. Next, we go to the investor, Zach George. Zach is the managing partner at Launch Africa Ventures, the most prominent early stage investor on the African continent. Then we move to Vivek Mittal. Vivek is tuning in from London. He's the CEO of AFIDA, the African Infrastructure Development Association, and he'll be giving his insights on African project investment. We then hone into Tanzania, and we warmly welcome Linda Teggisa from NMB Bank in Tanzania. She's the head of transactional banking and has over 20 years experience in African banking sector. And lastly, but not least, we have social impact investor expert and partner at Impact Amplifier, Max Pichulik. Max assists corporates and government agencies invest in Africa while creating meaningful impact. Thank you all so much for joining us today for this brilliant session. Over to you, Stephen.
Thank you, Nicola. So Sub-Saharan Africa has experienced 20 years of virtually uninterrupted growth since the mid-90s. Combined with greater political and macroeconomic stability in the region, this record has unseated the deep sense of Afro-pessimism that dominated the 80s and the 2000s, and has replaced it with a more optimistic and at times euphoric outlook. In today's session, we're going to scrutinise how to invest in Africa with some of the leading experts in the field, as Nicola's introduced, who are leaders in political and corporate risk analysis, investors in the startup sector, developing and delivering infrastructure, and the banking and financial services sector. Tara, you've been one of the leaders of political and corporate risk analysis in Africa for over the last 30 years. What do you think are the main changes that you've seen in the investment environments over these decades? You're on mute, Tara.
I'm going to unmute. The he has to do that. Unmute. Am I unmuted? Can you hear me now?
Yes, we can.
You can. Good. Well, I mean, just say, to put all those grey hairs that have been alluded to some work. I think when I started out doing this giving advice to companies, I was actually advising companies I was writing reports about how to best evacuate your staff out of countries and it was mainly foreign, multinational companies out of Sierra Leone, Angola, Mozambique, it was that sort of thing. And what I think people don't realize that underpins what you have just said is there has been a fundamental shift to much greater stability. And what actually has led that fundamental shift to greater stability, despite headlines of 5 days of conflict or 4 days of conflict in Sudan, in Khartoum, is actually a gradual improvement. And to me, that gradual improvement is a democratic improvement. So we've actually, it's on the back of regular elections and the fact that you can be guaranteed that a president will actually only serve 2 terms and then leave the stage, which is critical in places such as Nigeria, for example, where previously you would have had a military dictator clinging on to power for 30 years. Those days are well and truly gone. Again, in spite of what's happening in Burkina Faso, Mali, and so on, the fundamental shift is that one. Again, you've got new constitutions that protect people, that protect investment, that protect the individual. Two examples are South Africa, which is standing the test of time and much battering from previous from Jacob Zuma and his crew, but also in Kenya. In Kenya, you've got a new constitution that is underpinning a sort of an uplift in economic prospects. So I would say that's the first thing. Second thing that is the fundamental changing ideology of behind business. In those 30 years, we've shifted from basically Marxist style control economies to much more liberal economies. The biggest example of this, of course, is Angola. Angola, even though it's still got a liberation party in power, it's basically shed its opposition to liberal economic theory out of necessity, and we are seeing, Angola is a very prospective investment destination as a result. I think probably as part of that economic shift is tech. Technology with the emergence of cell phone technology, and I'm very proud to hopefully have on my epitaph that I was instrumental in bringing cell phones to Nigeria. So you can see the direction of travel. So, but really, cell phone technology has given other companies, other sectors, a really deep understanding of what the consumer is all about in Africa. And we're talking about, those drivers which are the same as everywhere, health, education, jobs, and then consumables, health, education, jobs, then consumables. And those, once you understand those drivers, you can understand where to pitch your stall, if you like. So perhaps I'll stop there.
All right, thank you. And as a useful segue to Zach, one of Africa's most renowned investors and prominent angel investors in early stage tech startups. It's often talked about Africa leapfrogging technology. Zach, can you give us an overview of this investment climate and how you see African-based venture capital growing, and how does this compare with international VCs in Africa?
Yeah, sure, Stephen. So first of all, if you look at the state of venture in Africa, you've got to look at it from three perspectives. You look at the global population. Africa accounts for about almost 20% of the world's population. It's the world's fastest growing consumer base by leaps and bounds. By the turn of this century, Africa will account for 1 in 3 human beings on the planet. So that's an incontrovertible truth. We have the highest youth population in the world. The average age in the continent is 19 versus 39 in Europe and 35 in the US, and a lot bigger in Asia. However, Africa only accounts for about the world's GDP. And then if you take it one step further, venture capital, which is early stage, high growth, high risk investments, accounts for about 1 to maybe 1.5% of global venture capital. So there's a double arbitrage, for lack of a better word, between population, GDP, and then venture. And it's quite amusing to me as an ex-Wall Street bank, the opportunity here to see the vast majority of globally relevant leading market cap companies in the world today, the Microsofts, the Googles, the Amazons, the Facebooks, the entire Dow top 40 stocks in the world, except for possibly Saudi Aramco and Berkshire Hathaway, are all funded by venture capital. But the top 20 or 30 companies in Africa, which are mostly telecoms, insurance companies, minerals, and sort of broadly speaking, primary resource-driven companies, are all funded by debt. So it's only a matter of time, if you join the dots, that venture capital is going to make its way down to Africa. And hopefully 10 years from now, the top 20 or top 30 companies on the African continent will be venture funded. So it's a question of really when and not if. So that's why you see just in the last 3 years with the boom in marketplaces, the sharing economy, more mobile phones than human beings on the African continent, you're seeing a gradual increase in the percentage of businesses that are getting venture funded. So just a couple of numbers before I take too long on this. Africa is the only region in the entire world where venture capital has grown in the last 18 months. An interesting stat this morning, Africa received more venture capital funding this past quarter than the whole of Latin America. That's never happened in the history of venture ever. So what we're seeing is a very high, we're starting from a very low base, but the rate of growth of venture capital to fund tech and tech-enabled businesses has grown exponentially. We're now sitting in just over $5 billion in run rate from a VC perspective. So it's something that I'm very optimistic of. And when the entire world is funding growth through venture capital, Africa being the fastest growing continent, from a consumer perspective, it's pretty exciting to see what lies ahead.
Just to build on that a bit further, Zach, there's been a lot of talk about the demographic dividend of Africa. Is it the? Could you unpack a little bit more this African consumer economy and why that's making the business opportunities for global investors more attractive?
Yeah, I mean it's quite simple if you dumb it down to basic econ 101. So, the average cost of data when I came to Africa 13 years ago was about $45 to $50 per gig, but across 53 different countries. Sudan hadn't split at that time. Now the average cost of data for a gig in Africa is about $3 to $4. Right, so it's reduced by a factor of 10 in just over a decade, right? 20 years ago there were more mobile phones in Manhattan than the whole of Africa. 20 years ago there are more mobile phones in America. So the world's moving into an increasingly mobile centric economy. And you'd have to be living under a rock to see, like I mentioned earlier, the average age is 19. Young people are significantly more digitally native than older people. Fastest growing economy, higher mobile phone penetration than anywhere else in the world, increasingly lower cost of data, and a higher penetration of e-commerce. I mean, when I came here 13 years ago, less than 2% of Africans had internet. Now that number is closer to 30%. So all these factors are just a perfect storm where the African consumer has significantly higher purchasing power. And with a continent of 1.4 billion people growing faster than anywhere else in the world, you'd have to literally be stupid to not understand the potential from a pure consumption perspective than selling to markets in Europe and North America where growth rates are negative from a population consumption standpoint.
Yeah, no, thanks for that, Zach. Yeah, and with the digital space, it doesn't really work without some physical infrastructure. So Vivek, as the head of an association of project developers, you're at the forefront of working with investors and spending millions of dollars into infrastructure in Africa, both digital and physical. Could you outline what is the role of infrastructure in Africa's development and growth narrative and story, not just historically, but as you see it moving forward in the future?
Thank you very much, Steve, and great to be here. So just so for those who don't know AFIDA, Africa Infrastructure Development Association is a nonprofit, and we have 50 members, of which about 35 have capital. So we have DFIs, funds, developers, corporates, and advisors in our network. And the 35 institutions that have capital account for about $50 billion invested. So our members actually talk in terms of investing in tens and hundreds of millions at a time. Now, so in that context, I mean, just taking forward the comments from Tara and Zach about, Tara mentioned the trajectory of development, and Zach talked about what the future is and what we have to do. All of this, I mean, infrastructure underpins that, right? I have just been 8 weeks traveling in 5 countries in Africa, including Kenya, Zambia, Zimbabwe, and South Africa amongst them. I was able to use Uber everywhere. I was able to host, join online sessions like this. I was able to do all my work from cafes in various parts of these 4 or 5 countries. All of that has been possible because of incremental infrastructure investment over the last 20 years. The question where we deal with is it's not happening fast enough. The doubling of population that Zach mentioned in the next 20 years, for example, needs a 4x increase in GDP to actually underpin prosperity of people. If you look at it, if we do the maths, I mean, and that sounds like a lot, but it is. That's what Vietnam, India, Brazil have achieved in the last 20 years. So it's very much the norm for African countries to be pitching towards that. There is a global energy transition underway. Now, what does Africa produce? Africa currently produces minerals, it produces basic energy and agri-commodities. There's not a lot of value-added stuff that comes out of Africa these days. That is to come in the next 20 years. If all of that has to happen, there's also geopolitics. So does African energy have a role in substituting what is deemed to be high-risk energy supplies from Russia, for example? Something there is, something there's not, right? There's climate change that affects and is a potential hindrance to this. So whilst there is a role for African minerals to supply and participate in the global energy transition, so there are these opportunities and threats out there, right? And what we find is investments in infrastructure, whether it is basic energy, whether it is roads and rail and transport sector, whether it is water, whether it is the backbone of the digital economy. All of that is necessary. There's a lot of potential, but we find that actually it's scale, speed, and the quality of infrastructure is missing. So that is where we are focused on a number of initiatives. And, this is just setting the scene, if you will, for further debate. And I'd love to hear from the rest of the panelists and indeed from the audience on what the solutions are for this.
Yeah, indeed, Vivek, and we'll come back to that issue about speeding up the investment gap, closing that investment gap in Africa and risk. But in the meantime, let's just start to do a slightly deeper dive and focus on a country. Linda, you've been in the banking sector for the last 20 years, and home Tanzania for you is one of, at the moment, Africa's fastest growing economies. What are you seeing as the key sectors in Tanzania that's attracting foreign investments today?
Thank you. I think Vivek has really, set the stage for, the varied sectors within which we see investment in Tanzania. So to start with, Tanzania does fall among the top 10 investment destinations in Africa, with about $922 million of FDI inflows in 2021, being about 34% from previous years. Now, the total FDI stock stands at about 17.1 billion, which is essentially 20% of the country's GDP. Now, that also leads to the fact that, IMF recently released economic data, which continues to place Tanzania among the top 10 largest economies in Africa, with a GDP of about $85 million and a projected growth trajectory of 5 to 7% year on year for the next 8 years. Now, what that transcends to is, some of the focus areas where we've seen FDI, and that is in mining, manufacturing, energy sectors that have been primary recipients. But we've also seen other sectors like agriculture, which is the backbone of the Tanzanian's economy. But then going back to what Vivek said about value addition, I think that's where some of the challenges are that need to be addressed. There's tourism and infrastructure, which have also, attracted FDI in recent years. And some of the countries that we see bringing in FDI into Tanzania are the likes of China, India, the UK. In the Middle East, you have Oman and UAE. In North America, Canada and the US, and other areas in Europe, Netherlands and Germany. Now, the rationale for FDI flows into Tanzania is really, natural resources, effective privatization effective privatization programs, as well as the commitment to sound economic policies. And we have also seen with the current president, Her Excellency Samia Suluhu Hassan, who has also championed the improvement of the business environment. And this positions the country well to spur increased foreign direct investment, particularly in the extractive industries where we see continuous interest in nickel, helium, and gold mining, but also a mega project in gas extraction, whereby we're seeing, the Equinor, ExxonMobil, and Shell, who are in, a very pivotal stage of signing a host government agreement where the project value is basically about $33 billion of LNG extraction. Now, we've also seen from China within the pipeline of investments, projects like development of the Bagamoyo port, which will be essentially an alternative trade gateway into, the landlocked countries that Tanzania neighbors. That also essentially includes an extensive road network, which also connects to the Tanzania-Zambia Railway. Now, this essentially brings us to, considerable funding that has been invested both, from external sources, but also internal sources, and has been directed to projects within the infrastructure space, such as the Standard Gauge Railway, ports, roads projects, to ensure that Tanzania remains, in its strategic position as a logistics hub, but specifically to unlock trade facilitation for neighboring countries within the Central Corridor. So I will pause there, but I hope that gives you a bit of highlight with regards to where Tanzania stands in terms of FDI. Thanks.
Yeah. Linda, I encourage you to be a little bit less shy and just explain where NMB is positioned to help support this growth trajectory. As a corporation, how is NMB supporting investors in Tanzania?
Well, NMB is a success story of privatization in itself. When you look at its shareholding of about 34.9%, majority shareholding from Arise, which is a consortium of Rabobank, FMO, and Norfund, and the government has also maintained a key stake with 31.7%. The bank is currently rated B2 with a positive outlook by Moody's. But when you look at the 24-year transformation journey where it started as a microfinance bank offering basic financial services, it is now a fully fledged commercial bank. It's listed in the Dar es Salaam Stock Exchange and leading in many fronts, over the past decades, being the most profitable bank in the country. Very wide, network with over 227 branches, which represents about 98% footprint for Tanzania, and an extension of agency banking, which essentially takes us to the alternative solutions, which expands our footprint into providing, access to financial services and promoting financial inclusion. And this also allows us to deliver, digital services which is also aligned to the country's focus in developing the digital economy. Now, the wholesale banking proposition within the bank essentially provides financing to flagship projects, specifically also in the infrastructure space. We have been fortunate and had the opportunity to participate in financing of the Standard Gauge Railway. The contractor that has been financed by the bank has been awarded a total of 5 lots out of 7 so far. Still in the infrastructure space, we have supported the capacity for the port, as well as the construction industry, which speaks to the number of projects that are within infrastructure development, and that is essentially supporting thousands of contractors to execute roads and bridges projects with innovative working capital solutions, which have essentially elevated even the participation of women-owned businesses, to develop capacity and to earn the allocation of contracts, which is within the procurement regulations. Now, we have a balance sheet, a growing balance sheet of over 10 trillion shillings, which essentially allows us to finance a single entity up to about $130 million. That can be done either on a bilateral basis, or we can undertake, risk participation in the form of syndications or club deals. And this is essentially to continue supporting, development in Tanzania, and leveraging on our capabilities for tailor-made solutions, both in trade and project financing, as well as digital solutions supporting transactional requirements, which are essentially powered by unmatched technology, which is at the center of our strategic focus. Our sustainability agenda has also been in focus. Most recently, we've had the first gender bond in sub-Saharan Africa, which has been listed in the Luxembourg Stock Exchange. So this nature of impact is what the bank continues to support, and specifically under the gender bond, the proceeds have impacted over 1,200 companies within the MSME space. And this type of financing has also set a benchmark for development of alternative asset class for investors. Thanks.
Great. Linda, that is quite an impressive story, and certainly on that social impact side, so it really talks to the world that Max invests in. Max, you come from the corporate investment world and now run one of Africa's leading social impact investment companies. What is the current state of impacting investing in Africa, and can you give us a little bit of insights as to what your clients tend to be investing in and where?
Sure. Yeah, it's important to frame the impact investing markets as very much an Anglophone global north movement, primarily out of Europe and the US, which gained traction, or was termed, the term was coined in about 2005. And impact investing sort of sits within the gambit of responsible investing, ESG, but it's very much taken traction in the unlisted space. Started very much by family foundations. It then extended to more public funders out of governments, and now everything from family foundations, family offices, multinationals, corporate banks. It's gained a very strong steam, and literally from the beginning, as we've seen the large banks and asset managers start to build impact investing portfolios, Africa has taken up a sizable chunk of that market. I mean, in 2018, I think we're talking at about $600 billion, of which 33% of that was going to sub-Saharan Africa, at least capital allocated, not necessarily invested. So it very much comes from the culture of the Anglophone world, and I would say that if you then maybe backward integrate the issues on the continent, if we see a large portion of young people who are urbanizing across the continent, who are lacking therefore large amounts of infrastructure in cities, and that infrastructure is essentially, in its traditional model, being centralized, industrialized, or non-existent at all. what we're probably seeing is a lot of interest in decentralized technologies, everything from renewable energy to waste beneficiation to water efficiency to green transportation and a whole range of technologies in climate adaptation and mitigation. So I think that's taking up the bulk of the interest. But if you think about Africa and, let's say circa 14% of its GDP coming from agriculture, and it involves 80% of labor or the population, agriculture and food systems naturally is a major piece. And obviously there's intersections between energy, agriculture, and water. So I think those are the big themes. Technology runs through all of them. Increasingly, we're starting to see a lot more interest in health technology, health innovations, particularly also in our indigenous plants and plant biosystems. So we have very interesting indigenous plants that have been used by our cultures that have incredible medical, cosmetic implications and IP. So it's really a broad gambit and quite a wide tent of interest, but it's very much not in the listed markets. It's very much unlisted in SME finance, but it's still emerging. I would say it got most of its traction and interest in East Africa coming out of Kenya and Nairobi. It's then kind of moved towards Central and West Africa and probably spread throughout East Africa, still very underdeveloped in Southern Africa. And South Africa has created its own flavor of impact investing in correlation to our Black economic empowerment codes. I don't know if that's a broad enough trend of what's going on.
Yeah, just one thing I want to pick up on there. You talk about the concept being driven some from the global North Anglophone world, but in terms of and you've gone through the sectors, but in terms of the Francophone markets in Africa, are you seeing the appetite and the desire to be investing into those markets as well? Because from where I sit in West Africa, I'm seeing huge growth and rebalancing of trade partnerships within the Francophone markets that we've heard being talked about for a long time, but haven't really been seen put into action until recent years, to be honest.
Yeah, I mean, if you look at Anglophone investment as a trend and impact investing into Francophone countries, I would say that's a trend that's, probably only 5 years old. But if you look at France and other French-speaking countries and that relationship, that's far deeper and far longer. So I think there's a huge weighting up, and I think geopolitically, and if we look at just the geography of West Africa and all the geopolitical shifts that we're faced, obviously most recently with the Russian-Ukrainian war, it seems that the competition up is and the heat is increasing massively. And just so recently, I've been sitting with the DFC and USAID and the State Department and the MCC and all the states, all the US state agencies that are really now taking Africa really seriously, largely under the banner of climate action. So they've kind of are positioning their Belt and Road Initiative underneath that, and now what I'm starting to see are very, very strategic key changes, and Francophone is definitely a massive target. So it's definitely a changing space. I would say in our experience, Francophone is relatively new within the last 2 years, and it's been run out of our Nigerian office. But we're still trying to get to know those countries and dynamics a little bit better.
Yeah, certainly Gabon is doing some amazing work in that climate resilience space at the moment. Tara, Vivek, I'll just come back to you both with sort of combining a question here. In terms of infrastructure, Vivek, there's this sort of well-touted number of $100 billion shortfall in the infrastructure gap financing every year. But from yourself and Tara as well, why do you think that gap is there? Is it because when they think about Africa, they think about corruption, or is it something else that's driving that? So perhaps Tara, come in with your thoughts on that, and then Vivek afterwards, please.
My thoughts.
Yeah.
Yes. So, well, there is a huge perception of, perception and unfortunately, a great problem with corruption linked to infrastructure and to mega projects and to some governments. We cannot, does that deter people from investing? I think there are other metrics that actually encourage people to invest despite a perception of corruption. But if you even just consider what's been happening in South Africa with state capture and the Zondo Commission, if you look at what happened in Mozambique with the notorious tuna bond scandal, where in fact the government colluded with a Swiss bank a Swiss bank lent an enormous amount of money to the government for an SOE, for a state-owned enterprise project, which then basically just proved to be a fund for corruption. And you see that model having been used there. You see that model of an external financer and corrupt governments using state-owned enterprises to then take that money off to Dubai or to some other money laundering center, usually in the sort of offshore world. And the scale of that is enormous. And it does impact investor appetites. But it's not universal, and there have been enormously successful and clean investments, even in the most difficult environments. So for investors, it is the opportunity, as has been outlined by Zach, which is both an infrastructure gap, an energy gap, and combined with an emerging demographic that will carry an investment prospect over a lifetime, over the next generation, in fact, is critical. I just want to say one thing, and a classic example of that is in Kenya, which has had, a little statistic that I trot out as often as I can, is that in Kenya, Kenya's electricity is 90% renewables. And that is from a mixed financed, the financing for that was entirely mixed between FDIs, private sector, and with limited government involvement. And actually a lot of that went ahead in what is perceived to be a highly corrupt environment. But careful planning and due diligence that obviously I would say that, but has enabled a lot of that investment to go ahead very successfully with no drama and no follow-up, no dangerous associations. And then now Vivek, over to you.
Thank you very much, Tara. So if I may be a little controversial and seek to add a different flavor to what you just said, Tara. I mean, I don't necessarily disagree with what you said, but it's the emphasis. So yesterday I finished watching this Netflix series on Bernie Madoff's scandal.
Yes.
There isn't a short supply of bad actors anywhere in the world.
Not at all.
And unfortunately, in Africa, we get more visibility on the nasty stuff than the good stuff. My members have, I said, over $50 billion invested in African infrastructure, and more or less well performing all of it. Now, that investment gap of $100 billion is the gap between what is required every year, estimated at $180 billion, and what we get is about $60 to $70 billion. So we get a $100 billion gap every year, and that's set to expand. The reason that gap is there in our assessment and what the work that we've done, one is the risk-reward gap that you have pointed to in Tara just a short while. The perception of private sector international capital perceiving more risk than reward in African deals, and governments actually sometimes justifiably on the continent, feeling that they pay very high tariffs for retaining a lot of the risk themselves. So that slows down investment. There is a bankability gap. I meet a lot of startup developers on the continent who can't raise enough capital. They struggle. The development timeline for most projects, a simple solar project, can take nine plus years in anywhere on the continent, except South Africa and Egypt and Morocco, perhaps, where they have had a little bit of success. But I also have many members who struggle to put out all the capital that they allocate every year. So there's stranded capital. So that's the bankability gap. There's an execution gap, and that, I've just alluded to that. Projects take too long to come together in Africa. Underneath that sits a learning gap. Now Steve is from UK Export Finance. We think of export and trade as a unilateral exchange of goods for money, but actually there is a cultural exchange and a learning exchange that goes on with trade. And we don't see enough trade within Africa. We don't see enough trade between Africa and the rest of the world. So there is an opportunity there. And there's a question in the chat about learning ecosystem, and that is what at AFIDA we've decided to pursue, to create that learning, to provoke that learning ecosystem. The way to bridge this $100 billion gap in our assessment is really to get that development narrative right. What is the role of infrastructure in actually expanding? There's a lot of confusion and conflict in the way international capital and even national governments come at this, even discounting the corruption, but there is corruption. I'm not saying there isn't. There is short-term thinking. There is an instinct to ask for money where there's a lot of local capacity. So then there is an opportunity in correcting the narrative, which will help in unlocking this capital, or addressing or reducing that $100 billion gap. The second is local is best, and by that I mean, we look for capital outside Africa for 100% of the requirements. There's a lot of capital on the continent. And I'm really delighted that, NMB Bank, represented by Linda here, the work that they're doing. We don't see enough of that on the continent. It is when people, local entrepreneurs in country, businesses in country, they are the ones who should be taking this opportunity forward. And international capital will follow as a result of that. International capital should be an add-on rather than the primary source of capital. So I'll leave it at that. But there are these sort of ideas, and I'll just finish up by saying, we have our Catapult Accelerator, which is exactly geared towards dealing with this. We have training courses on project development and project finance that are starting out this year, and we're building out a marketplace where people can meet each other a little bit easier. And there's other initiatives that we are focusing on, but hopefully some of this lands as possible way forward.
Thanks, Vivek. Max, you wanted to come in with the comments on that?
Yeah, I just want to add to that very important layer that Vivek mentions about, and this is the low-hanging fruits, is that investors right now across the continent are sitting on billions of dollars of money that they're just not deploying. And trying to understand why this is the case, at least in our work for the last 15 years, sometimes an entrepreneur can't find the money because there just isn't an investor. But where there is money, there are a few key things that I pick up. Is often investors communicate on their websites about what they invest in, but actually when you pick up the phone, you deal with one of the fund managers, they're actually looking for something completely different. So there's often a miscommunication between what investors, what the typical profile of deal they look for versus what they're actually, and this sits across the bandwidth. The other issue is, if you're dealing with global north money, and Zach and I have had lots of chats about this, there's this cognitive bias because someone sitting in Paris or in the US would want the entrepreneur to look, feel, smell just like them, be educated like them, speak the same language as them, And that's just not the case in the African continent. You know, often English is a second language. These aren't entrepreneurs who've exited multiple times. It might be their first venture experience. So everything from their storytelling to how they communicate is a culture mismatch. And we actually have to deal with that. Sometimes these hit race dimensions too, which we find out, which I think really frustrate African entrepreneurs. But I also think there's this perceived lack of sophistication that many global North investors think African entrepreneurs have, which is often not the case at all. It sits within these cognitive biases. But I think African entrepreneurs have a long way to really speak the language of investors, tell a very compelling story, have a very clear growth strategy, very clear financial projections. And I think a lot of the gap that we can solve in the short term is just solving that storytelling relationship gap of money that is already sitting on balance sheet, that fund managers are just earning fees. And it makes me sad that they're actually not deploying. And I think if we can, and this is actually about not only how the ecosystem operates, how the investors operate, it's an education to the entrepreneurs. It's all the intermediaries that sit between the entrepreneur and the investor, which are only startups and have only emerged in the last 10 years. And Zach will tell you too how that ecosystem looked very different a decade ago to how it looks now, and their sophistication has changed. So I think a lot of our work in the short term is just actually to fix that. If we can fix that, we can actually deploy a lot more money.
Yeah, Zach, there's some really rich information to discuss there and issues. I often see the challenge of the gap between the perception of risk and the reality of risk in Africa. And with sort of long lead-in times for infrastructure, like Vivek saying, sometimes 9 years, it really brings in the time consistency risk with certainly our political partners in Africa, where there's government involvement, where there's a complete mismatch between their electoral cycle, the political calendar, from the real economy calendar. Do you think there's a need for investors in Africa to have more appetite for working with risk with African-based startups, so that or is there a need for them to drive a better understanding of the reality of the risks? And what are the typical success rates you're seeing in terms of successful and lucrative exits for investors who have that appetite for the risk? I think we have a technical problem with Zach. Zach, can you hear us? Whilst we're just dealing with the technical problem, would anybody like to step in on that question? Tara?
Well, having raised my hand now, the thought is completely out of my head. But just, thinking about, extending that thought about risk and the perception of risk, it's the actual reality. I think the critical thing is actually to know what's going on in your marketplace from the and to make, one of the things that we have been talking about is genericizing the continent to some extent, and we have to for a forum like this. But actually if you look at even a state in Nigeria, if you looked at Lagos and then you look at another one of the northern states in Nigeria, as you well know, we're talking about totally different risk profiles. So, I think a granular knowledge of what the actual risk is from multiple perspectives is always critical.
Great. Linda, do you want to come in on this point as well about, as a commercial bank, it is about risk adjusting your returns on what you're submitting. What are your perspectives about how do we address the issue of appetite for risk in Africa?
I believe Tara alluded to it. I mean, it is really essentially about, understanding the market, understanding, the client that you're dealing with, having a very thorough due diligence process. I mean, as banks, we're in the business of managing risk. And the due diligence process is actually, primary to ensuring that we're able to assess the risk. And I think the point that Max raised, regarding the perception of risk in terms of whether is it a perception or is it a reality? I think that is essentially something that we're industry players as well as banks can work together in order to ensure that, the right information comes through during the due diligence process in order to make a fair assessment of what the risk is and essentially providing the financial support that is required in order to bridge the gap with regards to the capacity to invest.
Great. Thanks for that. Zach, I'm not sure if you heard the original question there in terms of the need for more appetite for risk and the challenges of perception and reality, and where you've seen the appetite for risk to invest. What have been the typical success rate in terms of exits, successful or lucrative? And perhaps you could also pick up a question that's in the chat box around that in terms of the vulnerability of entrepreneurship if organizations are running through debt and there's a lack of VCs.
Yeah, no, for sure. Again, apologies for that. To Vivek's point earlier, South Africa, despite all its achievements, still struggles with load shedding. So infrastructure needs to be priority. That's why I lost connection briefly. So around the question about exits and returns, I'd rather just answer that with some facts versus opinion. So not everything gets spoken about in the media, but facts are facts. In the last 4 years, there have been 125 exits in the VC industry in Africa. That is fact, it's not an opinion. Out of those, 38 have come from South Africa, 34 have come from Egypt, and about 20 odd from Kenya. What you don't hear in the news is the value of these exits, right? So South Africa is a very attractive economy from an exit perspective for technology startups. However, the multiple that corporates in South Africa, specifically, I call it the oligopoly, so the insurance companies, the banks, the telcos, and the retailers. It's pretty funny how we call ourselves the Big Five, but there's a Big Five everything. There's a Big Five insurance mafia, right? There's a Big Five bank, there's a Big Five telco. And oligopolies control the way, relationships work in this continent. So having oligopolies in a market like South Africa is ironically a good thing from an M&A standpoint, but it reduces the purchase price negotiating power that founders have. So whilst we've had a lot of exits in South Africa, the value from a multiple of either revenue, transaction volume, or active users is actually quite small. And Nigeria, where you don't have as many oligopolies, you tend to have lesser exits, but higher values as a function of revenue, et cetera. So I think as founders, you really need to understand what your route to market is. And, no points for guessing that if you've got a B2B business model where you can outsource your distribution through telcos, retailers, and banks and insurance companies, you've got a much better chance of creating value through M&A. The IPO market is dead globally, so let's not throw stones at Africa because we're pretty much on par with the rest of the world, the IPO market. And I think personally speaking, taking your company public and spending millions of dollars for listing, where you're dealing with unsophisticated investors trading your stock, is not probably the best way to sort of create liquidity when you can create liquidity through other smarter pools of capital. So exits have happened. There are, like I mentioned, 100 plus of them, and it's a question of finding out the right buyers. You're going to see a lot more. Well, the last point I'll say here is you're going to see a lot more horizontal M&A on the African continent versus vertical M&A. So vertical M&A is when a large corporate buys a smaller startup purely from a customer acquisition play or from a FOMO perspective for the Gen Zs listening here. Horizontal acquisition is when you have larger fintechs buying smaller fintechs, Stripe buying Paystack, Wave buying Send Money, and many like that. So I think you're going to see a much larger consolidation across the continent of tech startups buying smaller tech startups. And that is, if you look at what happened in Silicon Valley, Bangalore, Shanghai, and Tel Aviv and Berlin, that is exactly what's happening right now in Africa. So yeah, it's something to watch out for.
Great, thanks, Jose. Just going to go to the last question before we go to sort of closing thoughts. Max, I'm also going to bring in a question from Tony. Are shifts in global geopolitics affecting impact investing landscape in Africa? And are you also seeing with the investments from China crowding out the space for impact investing in the continents as well?
So I think this is going to be very tricky in this time. My views currently, the way this geopolitical split is happening and the rate that it's happening at, is that countries might have to make a choice, or there'll be a whole range of confluences or influences making a choice. This has, I think, tremendous negative impacts because, you know, investment decisions, particularly from the global north being made onto the continent, now have a whole range of other facets of considerations that are being made. And these are really based on allegiances. So I really, I mean, at least in South Africa, I'm noticing a huge interest, and you can see it start to come out in the tourism numbers, for instance, of Russian business people coming to South Africa, properties starting to be purchased. You can really get a sense that you can get a sense, at least from the aid agencies like USAID and others, just how tentative they are at the moment, because it seems that you know, with previous USAID administrators, it was largely the politics or the geopolitics kind of amongst the staff of USAID tended to be secondary. But I think under the current administrator, under Samantha Power, we're starting to see it becoming front and center, and negotiations around supply of money across what was, you know, parts of OPIC and going into DFC now, and USAID and MCC are going to have very vast political ramifications. And I think South Africa, for instance, is one of those countries who is tentatively on playing both sides. And so I definitely feel it there. But some countries have very clear orientations already. So I think it's a space to emerge and watch. But I wouldn't be surprised if we start to see an acceleration of parallel payment infrastructure being set up, different global banking standards being set up, and an entire parallel digital and finance system that starts to emerge on the continent. And obviously that has an implication for the work that we do.
Very good, thanks. So just in the interest of time, the last minute before we close, any very final short words from the panelists about any advice for the participants to invest into Africa? A couple of words. Tara.
Very happy to say, I mean, I would just absolutely say that knowing your environment first and foremost, knowing it in detail. The risk of corruption, and unfortunately, is very real. So you also need to really know who your counterparts are. But both of those are extremely doable and are actually a very effective measure of de-risking. So we should actually be looking at de-risking rather than perceptions of risk. End of.
Thank you. Vivek.
I would, first of all, thank you. Very interesting insights over here. My single suggestion is for investors, capital, entrepreneurs on the ground to get into the game. This over-reliance on international capability and capital is not helping the continent, and it's going to make the difference between success and okay performance in the next 30, 40 years.
Great, thank you. Max, final word, advice.
Yeah, it's advice I keep on giving to myself is really stay open, stay humble. Africa's got so many different cultures, ways of thinking, ways of being in the world, and really being able to build strong relationships, understand opportunities over long periods of time, strengthen relationships incrementally. And if you are investing, I would even consider performance-based investing onto the continent. Form a relationship, start dating, look at the first tranche of capital that's required for any particular deal, make it milestone based, pass it over, see how what results, and try and build small amounts of relationships over 20, 30 years. I think that's one way of success, and a trusted network.
Right. Linda.
In the spirit of remaining open, I think the trade gap that was highlighted. The trade gap that was highlighted earlier with regards to, trade within Africa, but trade out of Africa as well. I would like to point out on the, advent of the Africa Continental Free Trade Area. I think that remains a key opportunity to spur investment within the continent, but it also basically gives highlights to some of the attributes that countries have. For Tanzania specifically, I would say, the youthful population, which is very similar to, the general Africa demographic, political stability, abundance in natural resources, the strategic geographical location, which is a trade gateway to Uganda, DRC, Rwanda, Burundi, Zambia, and Malawi. I would say those are key opportunities to look into when considering Tanzania as an investment destination.
Great. Well, thank you very, very much for your time this afternoon. Let me pass you back over to Claire, who will close the session. Claire.
Thank you so much, everyone. That was truly a fascinating and insightful session. We will be posting details about the next Talking Up Africa episode on our LinkedIn page. So please have a look. Any questions for our team, please do reach out to us again. Thank you much, Stephen, for the brilliant moderating, and to our amazing panelists. Thank you very much.
Thank you.
Thank you.
Thank you.